Ghana's economy has contracted once again for the second consecutive time this year, but at a lower rate than what was recorded in the second quarter. The contraction of the economy in the third quarter is largely due to the impact of COVID-19 on economic activities. According to figures from the Ghana Statistical Service, the economy grew by a negative 1% between July and September. Here's the government statistician, Professor Kwabena Ailing, explaining what amounted to this.
Highlights of Quarter 3 2020 GDP. The Quarter 3 20 GDP at current prices was estimated at 92,223.9 million Ghana cedis, and this corresponds with 85,551.8 million Ghana cedis that was recorded for the same period, that is Quarter 3 2019. So from a current prices point of view, we see that there has been an increase from 85,551.8 million Ghana cedis to 92,223.9 million Ghana cedis. From a constant terms point of view, where we discount the effect of price changes and look at this solely from an output point of view, Quarter 3 2020 GDP was estimated at 41,059.6 million Ghana cedis as against the 41,511.4 million Ghana cedis that was recorded for the same period, Quarter 3 2019. Ladies and gentlemen, this indicates that there has been a reduction of close to 500.4 million Ghana cedis. The year-on-year quarterly GDP oil growth rate for Quarter 3 2020 was 1.1 compared to 5.6 that was recorded for the same period, Quarter 3 2019. The year-on-year quarterly GDP from a non-oil perspective indicates that the economy contracted by 0.4% as against the 4.6 that was recorded for the same period, Quarter 3 2019. Information and communication subsector recorded the highest expansion in the economy, 51.3% of the growth rate, but it must be emphasized that given that its share is relatively minimal, its effect on the overall GDP was less impactful. Hotels and restaurants subsector experienced the highest contraction of 62.1%, that is.
Well, let's digest this issue very well, and to help us understand issues better is a research analyst with Data Bank, Courage, that he joins us via Zoom. Courage Bote, we're so grateful that he joined us. First of all, on the cedi, of course, the local currency could end the year selling around 5 cedis, 83 pesos to the US dollar. Is this an impressive performance?
An FDA review found...
Hello, Courage. If you could hear me, I was finding out from you whether or not the performance of the cedi having to close the year at around 5 cedis, 83 pesos to the US dollar is impressive. What's your take?
It is an impressive performance. Thank you and good afternoon to your listeners. I think that the cedi story has been the otherwise positive, or if you like, the silver lining in the whole economic story for the year 2020. And I believe that the bulk of Ghana's interventions right from November last year, where they introduced the bi-weekly FX options, plus the early issuance of the Eurobond in, I think, somewhere February this year, and then the many other interventions that we've seen. And the fact that Ghana's export sector relative to our African neighbors seem to be more diversified, in the case where, even though we were battered in oil prices, we had gold and cocoa holding the fort, were actually the reasons why we had strong reserves supporting the effects. And then so where it is now, and then the time left to go, it tells you that we are doing less than 5% up depreciation this year. Even the worst case scenario for the last 2 weeks, we won't be exceeding even 4% depreciation versus the USD on the local market, on the interbank market. So it appears that the cedi's performance has been the positive story so far.
Great. Well, we have also heard the government statistician on inflation. Of course, we're seeing somewhat of a downward trend to the inflation despite issues of overruns in terms of the budget. But how could the performance of the cedi impact inflation moving to 2021?
Well, going into 2021, of course, inflation has gone up and now is reverting to where we're seeing a 9.8% at the last print. And then we have just 1 year to go. In fact, our expectation has been that it would end the year around that 9.8% level it is now. Now, the factors that accounted for that, we saw a lot of fiscal pressures along the year, obviously due to COVID. Government had to run a budget. We saw a sizable monetary injection from the central bank to the point that as we stand now, money outside of the banking system is actually, the growth in money outside the banking system is actually more than twice what the level was at the same point last year. But all of that hasn't really translated into high inflation beyond the price shocks we saw from the pre-lockdown price pressures.
Great.
The reason I believe is that economy is performing, we know, largely below potential, and there is so much slack in the system and potential for growth. So we believe all those monetary stimulus and the fiscal stimulus packages that has actually increased the fiscal pressures have gone into stimulating growth. The reason probably we are moving from a sharp contraction, or we are not experiencing a sharp contraction, and we are on course to recover in the fourth quarter GDP-wise. So going into 2021, I think inflation scope looks more stable. The expectation along industry and then from consumers appear well anchored, and that would give the Bank of Ghana, I think, the basis to sustain its monetary accommodative monetary policy stand to support the growth recovery agenda going into 2021.
Great.
So we do not expect so much. Yeah.
Well, Courage, let's not talk about COVID-19 and the impact on the economy, because as you rightly stated, we've experienced some, slight contraction in the growth of the economy in this particular regard. Do you think that our shocks wasn't much stronger to contain the strains of COVID-19, having heard from the government statistician about the matters of economic growth contracting?
On the contrary, I think if you compare Ghana to Nigeria, the South Africans, and a few of the economies that surround us that we can call our peers and compare ourselves to, I think our story has been a more positive one. There was, I think, a contraction of 3 point something in quarter two, and now we are talking of 1.1%. If you look at the numbers on a quarter-on-quarter basis, actually, you see that the economy quarter-on-quarter grew from the level we saw in quarter two now to what it is. It tells you that we are closer to returning to positive growth, in quarter four. And that speaks to probably the fundamentals of economy. And then you can see that this current government focus has been on expanding agriculture, industry, and all of that. During the lockdown, the sectors most hit will be the industry and services sector. And the fact is that those industries are dominantly driven in the industrial sectors or the city centers like the Kumasis, the Accra, and those were the places that experienced the lockdown really heavily. And so you see agriculture is growing remarkably, I think 8.9% or so for this sprint, whereas industry and services are contracting. But you look at the overall and you see that the path to recovery is actually quite commendable, and that points to a complete recovery in quarter four. So I think that the nature of our economy and the work that has been done over the years is what has helped Ghana to navigate the situation better than our peers in the African sub-region.
Great analysis there. But Courage, let me end with you on this question. For the investors, watching us right now, where do you think they must cast their net moving to 2021, having to consider these two major issues, the cedi and the slow contraction of the economy? Well,
where investors will be looking at, I think what they will be interested in more is the fiscal story going to 2021. Obviously, we will run our budget from the fiscal rule of 5%. The projection is we are doing 11.1, 11.4. We could slightly exceed that. That is not a good story, but everybody understands the reasons. And then even digging deeper, you realize that the 11.4 could have been less if government committed to staying disciplined and cutting back on some of the planned expenditures in the wake of revenue shortfalls. So I think what everybody will be looking for to inform the investment decision will be to what extent would government return to the path of consolidation. They could not lose as much revenue going into 2021 because of of course, the economic malaise we have and the need to stimulate the economy. So you do not want to spread businesses with increased taxes or new tax lines. What they can certainly do is to cut back on expenditure. Fortunately, I mean, believe it or not, fortunately, they have won a second mandate to now superintend over the affairs. So I think they would have the room now to sit back, look at where to cut back and stabilize the macro fundamentals before ultimately going into the overdrive again.
Great.
And if we can cut back on the expenses and go back on the path of consolidation, we may win the confidence of investors. Mind you, the concerns already have been about the debt situation, which is already crossing the 70 mark.
So indeed. I mean, even as investors would have to cast their nets wide, government would also have to check the budget overruns. We're so grateful, Courage, that you joined us for this analysis. He is a research analyst with DataBank.